What's up everybody, Tom here with another video. Today we'll be taking a look at the latest stock market news for the week ahead, along with our technical analysis of the S&P 500, NASDAQ, Volatility Index, and Dollar Index, using our top-down technical approach. This week we'll see key event risk as the FOMC meeting is sure to spike volatility in the markets. Let's take a look together at what you should be doing this week in the markets. Stay tuned. So as we like to do on this channel, let's try and take the complicated out of the stock market and simplify it together. One of the ways that we can always do that is by having a look at a heat map of the S&P 500 and understanding what's moving and not moving in stocks right now. Well, of course, the same thing that was happening last week during the sell-off is happening still, and that is that the tech stocks are taking a pummeling. Of course, the FANG stocks, being Microsoft, Apple, Google, Facebook, and Amazon, were down last week. Also, interestingly, Walmart was down when it moved so heavily over the last month. And of course, the other interesting factor was that the energy sector was down. And of course, the energy sector needs a lot of support from OPEC because the supply and demand does not necessarily make sense right now. When we take a look at this chart from Yardeni.com, we can actually also see how badly energy was hit over the last month. So this is September performance month to date. Now, we did have some positive days in September during the start for, of course, tech. So information technology is down 7.6%. And of course, then the least performing sectors are communication services and the actual S&P 500 overall. What's interesting though, if you're looking for dip buying in things like materials right now, or utilities, you're not necessarily getting the value. And that's the interesting part of all of this. We're seeing a difference in, of course, markets where growth stocks and stocks that are really hard hit by the current virus concerns are, of course, moving down, whereas some of the other sectors are actually acting quite defensively. And this often does happen in markets. Certain sectors will always be more defensive than others, and we're seeing value not move too much, whereas the growth stocks, of course, are moving down heavily after their huge move up. So before we mention key event risk, and what does this mean? Well, this week is all about the Federal Reserve. It's all about the FOMC meeting on Wednesday, which starts at 2 p.m. in the US, Wednesday, September 16th. We've also got the man himself, Federal Reserve Chair, the printing press, Jerome Powell, is coming out and he's going to be telling markets a little bit about what the Fed has planned in the future. Now, we saw 2 weeks ago the Federal Reserve move to a new monetary policy regime called average inflation targeting. Basically, they are still looking at the 2% target, but now they're looking to proactively push inflation above the long-held 2%. And when it's above this, they're looking at, of course, doing some kind of sustainable basis approach to try to keep it there. So this means that the Fed has really changed the way they're looking at the markets. They used to target a level, and then, of course, they used to tell everybody in the markets that they were signaling that rate hike. Now, of course, what they're basically saying is that they're going to not be as fast to move in terms of rate hikes. And I think this is why, of course, a lot of the equity markets know that the Fed is not looking at raising rates anytime soon. Equity market turmoil could be likely this week if the Federal Reserve don't give the market what they want. Basically, the market wants more policies, more support, all of those types of things. But if we don't get that, then we'll see a spike in the US dollar and, of course, a decline in the stock market as a whole and other equities. So I think this particular concern will be seen most in the dollar index. We've seen the dollar being crushed, and this is the way that the Federal Reserve wants it to be. To cause inflation, they really want low dollar, and it's not good for them to have a huge, expensive dollar over the longer term. Now, when we consider the technicals here and we have a look at the dollar and we have a look at the daily, we'll notice straight away that we're above the 20 moving average, which is this red line. We mentioned this last week. We also mentioned that we had a bullish hammer or pin bar, depending on what you want to call it, and that came off after it got through and actually looked like it was going to fall back down after getting through the 20. But the 20 is quite a strong signal in this particular pair right now. So what do we expect this week? Well, we actually expect that the dollar may increase a little bit and may start to push this target of 93.80 to 94. Why is that? Well, ahead of key event risk, generally markets like to move to a key resistance or a key support. Now, of course, a key support would be getting back down below this particular bullish pin bar right now, and a key resistance would be the 93.80 to 94 zone. And no matter what stock you're trading or currency you're trading or commodity or anything, when you have big news coming out, you will usually see a gravitation towards a key resistance or a key support. And that's especially true in stocks ahead of news and earnings. So for the dollar index, we're really looking at it pretty much moving potentially up to that 93.80, and then of course volatility to resume in this particular pair as the Federal Reserve says what they want to say. If the market did break through the 93.80-94 zone, we'd be getting through a 50 EMA, and then that would create a buying opportunity, as we've seen basically an accumulation channel down here. For sellers of the dollar, if we get below this pin bar, we pretty much create a selling opportunity back into the lows over here and potentially even further downside risk after the Fed meeting. So there'll be a lot of movement on dollar this week, and that is our expectation. What about the VIX, the volatility index, the fear index? Well, the VIX is back on the 20 moving average as well. We saw a spike, of course, followed by a decline in the VIX, which is pretty normal when you see movements in the market slow down. We saw that initial shock in the markets, followed by a bit of consolidation that we'll be looking at very soon in this video. But the VIX basically hit that 26, and for any bear out there, you want this level to hold, of course, because this is a point where you expect the VIX to spike again. We'd want to be seeing the VIX hold this level and then lightning bolt off the bottom. So basically moving up on the small one, moving back through and getting through all the key levels, which being 28, 30, and then of course it gets through 30, back into the highs of 37.5. So that could be possible ahead of the FOMC meeting, but time will tell. So the VIX is at a critical point as well. What's copper telling us? One of the lead indicators of economic recovery. Well, copper, we were talking about how it could have been a double top. It still could be a double top or a triple top even, with copper maybe moving back up here. And then if it does decline and get through the 2.95, the important zone, become a zone where basically we'd see this movement between 2.95 and almost 3.1 to the downside. And that would push us back into the 2.8 area. Now, if that happened, of course, we'd see probably equities fall lower, and we don't want to see, of course, copper get through this zone, as that would be signaling more of a crash effect in the markets rather than just a standard correction that we're seeing right now after the big move. What about the S&P 500? What's going on there? Well, I think the best thing to do is to start with the monthly pivots, and then we'll go through our top-down approach. So the S&P 500 is basically hovering at an incredibly important zone. It's stuck around this 50 EMA, the blue line here, and we've also got this monthly S1 pivot sitting at about 33.48. So we're sitting at pretty good support right now. It's actually the first big dip buy zone that you'd expect Wall Street to be getting into, and we'll talk about that soon. If the market did fall through this point and get through the 3300 though, we would expect that it potentially puts pressure back down on the monthly S2. And the monthly S2 sits right at the 3200 zone where we've got previous market structure, we'll talk about soon, at that level. So it's a very important key monthly S2 here. And I think it's hard to be somebody that doesn't look at this and doesn't say that could be a zone where we're going to see buying support by, of course, Wall Street if it hits there. I just want to reiterate, monthly S3s are seldomly hit, and generally even monthly S2s are not hit that often. And we can see that when we go through a huge back history of the generally larger monthly pivots. So it's pretty important, and of course it's one of those things we want to be watching. Let's now talk about the monthly in terms of our top-down approach. So what's happening on the S&P 500 right now? Well, I'm sure everybody out there knows, of course, we've had a decline. We've had a movement down from the 3600 or just below the 3600, and we're moving down now, and we're pretty much sitting around that previous kind of high in terms of bodies. Now, these are monthly candles, so what I like to do is I always like to line them up to the body or the close. Remember, each candle and each time frame is a bit of a war in the markets, and we want to make sure that we're very well aware of where the closes happen, as that's the most important thing about candles. The wicks matter a lot less than the closes themselves. I also want to put this particular correction in a little bit of perspective using the monthly. If we have a look here at a fib of the entire move from the wick to the top wick, we can see that the 23.6 pretty much lines up perfectly with that 32 kind of 50 zone, the previous highs. It makes sense that this is a level that you would see in the market, but it's still not a very large correction. Generally off large moves, you see upwards of a 38.2 correction, but because of the nature of this incredible bull run, that may not be happening. So the 23.6 fib is sitting right at this zone. And let's now go down to the weekly and see what else we're seeing at that point. Well, we've got our horizontal line here drawn on the monthly. That showed us the body closes, and I think that's very important. We've also got a 20 moving average sitting right around this 32.20 zone, 32.10 zone, and previous weekly closes there. So if we're going to line it up with the most recent relevant data, I think we want to take the body closes of the weekly, which we can see over here, and we've got that 3200 moving average as in the 20. Now we know the market likes to come back down to the 20 during aggressive moves, and often in the corrective phase, it'll come down and hit this level. So 3200 is certainly in sight for bears this week ahead of the FOMC or even after the FOMC meeting. If the market moved underneath the 3200 zone, it becomes pretty clear we'd open up the 3000 zone, and basically the market would be moving in 200-point chunks on the way down. There's quite a lot of structure at each 200 points, so 3000 into 2800 into 2600, all those areas will be the key zones if we were to see a further correction. Let's go and have a look at the daily. What's happening there? Well, the daily shows us a tale of basically a market stuck between two moving averages. We've now found resistance at the 20 moving average, and we said that that would probably make sense last week because, of course, the 20 moving average acted as dynamic support, which will usually mean it acts as dynamic resistance. So effectively on the smaller time frames, we're stuck in a range. We're stuck in a range between these two moving averages. And if we remain in that range as they come down, which I don't really expect us to because of course of the Fed meeting, then we will have, of course, a coiling market at this point. And that would show a lot of accumulation, especially if it broke out above. At this stage, though, I'd just be looking at it as the 50 is, of course, the first buy zone for many, many investors out there and longer term holders and traders. If it gets through this zone, 3200 becomes the next area of strong support and, of course, the next area that we want to be looking at. Let's go down to the 4 hour now and talk about what we actually saw in the markets in terms of the real S&P 500. So the real S&P 500 actually did close a 4 hour at a new low in terms of during market trade. But more importantly, notice this 20 and this 50, they're getting very close together. Now, let's have a look at the run up. Let's have a look at what actually happened during this bullish run. On the 4 hour, we have not seen the S&P 500 as in the real market cross below the 20 and the 50. We have not seen a cross since April 20th, and of course, the crash point where we saw it crash last time and go through. So this is again a big decision time and a big decision week. If we saw further movement down and we got to 3200 without bouncing up next week, we'd probably get across at the 20 and the 50. And we can see that's quite a strong indicator because we have not had one in a very, very long time. So it is crunch week for the S&P 500 from what we're seeing on this particular chart. Let's now take a look at the NASDAQ. What's happening on the NASDAQ? Well, the NASDAQ shows us that it's pretty much just really returned all of last month's gains. This is the month of August. This is the month of September. So we're basically reaching that point where we're taking off the full month. There's not much else to note, I really think, about, of course, where the NASDAQ is on the monthly. When we go down to the weekly, straight away, we see the same thing I've said for quite a few weeks, which is that it's trying to come back to this 20 moving average and try to get some kind of normality back in the market. This is pretty much the blow off right now. So do we see it return back to this 10.5 level? I would expect quite a lot of buying at 10.5, which is where this red 20 moving average is. We've got great support structure through this zone. And of course, we've hit the first zone here, which is the 11,000, the previous resistance of the structure. So we had a bit of a channel back there, which we telegraphed and we talked about how that was really pushing for high highs. And it did so, it just went over and above even our expectations. So the 11,000 was reached, the 10,500 could be breached and then hit. And we expect big buying here from institutions and other larger players in the markets if it was to happen in the FOMC meeting. Very similarly, we have a stuck in between two ranges. 20 moving average and 50 moving average here are holding the markets this week. And when we go back and have a look over it, we can see again, we have not had a 2050 cross for a very long time, but it does not look like we're getting a 2050 cross anytime soon on the NASDAQ when compared to the S&P 500. So a break below will pretty much signal down, of course, to the 10.5, and a break above this high here, if we go down to the 4 hour, so a break above this 11,600 zone will really signify a double bottom in the NASDAQ. So we'd have a low followed by another low, followed by the intervening peak or high. And of course, if the market was to move up, it would be getting through a whole bunch of moving averages on the 4 hour. We'd be getting through the 20, we'd be getting through the 200, which is the green line, and we'd be getting through the 50. Now, if that happened, that would be incredibly bullish to the market. In fact, it would signal that we're going very heavily long, and we'll be talking about that on this channel as well if it does happen. But more importantly, if you get through that zone, what is that also telling you? Well, it says we got through the moving averages, so all of those moving averages then act as dynamic support. So I do believe that this level is key, and if it does happen, we will see further big bullish aggression in the market. I think it's a very critical point on the NASDAQ over the next coming weeks if we get through that zone and don't make a new low. Similarly with Apple, critical point for it this week, 50 EMA. We did not see a close below this big bullish pin bar that happened. If we do though, it signals back down to 100. And I think Apple shows us a lot of sentiment on the market right now. So another great week in terms of a really critical point, and we should see the action happen. So as always, if you've enjoyed this video, please make sure to subscribe and of course hit that alert button. We'll be doing plenty of live streams starting with the opening bell on Monday. So make sure you come and visit the stream during that time and share with the community some of your ideas, and of course ask me any questions that you might have. Good luck everybody this week. I think it's going to be a key event, volatility, and of course we could see some fireworks for sure. See you soon. Bye for now.